to First Intuition. Welcome to this Tax Processes for Business revision session. We're making our way through the First Intuition mock number 1, and we've got as far as task 7. And tasks 7 and 8 within this assessment are on the payroll element of the syllabus. So that's where we're going to be going today. My name is Anne. If you haven't come across me before, I have actually done lectures for the other tasks in this assessment. So feel free to tune into some of those, particularly task 1, where we just run through our approach, how the FI materials work, alongside a little look at the various tasks that are included. So yeah, maybe a good idea to have a look at that sometime. So let's go next then to the reference material, where we will see that we actually have quite a bit of information in there relating to payroll. So sections 20 through to 25 in the reference material are all about payroll. So I need to have those on hand as I tackle some of these questions. This task is about principles of payroll, 12 marks. So what will we need to do? It's going to be all about the process of registration for pay-as-you-earn. So if we are in a position where we didn't have staff before, but we've started employing people, we need to now register with HMRC as an employer, if you like, somebody who will need to account for pay-as-you-earn. That's our registration process. So we'll be having a look at that. Understand the documents that need to be produced. How often? What are they? What do we include on them? And how long do we have to keep them? We're going to talk about the relevant documents to an employee's pay. Relevant deductions, get the words out, the relevant deductions from an employee's pay. So we start off with their gross pay, we then deduct maybe student loans, maybe they're part of a charitable giving scheme at work, they've got tax, national insurance and pension, maybe medical scheme, etc. Then at the end of it, we've got this amount that's left. And perhaps by that point, we're wondering why we go to work because so much of it's disappeared along the way. But we do look at all the deductions, and then we need to be able to calculate things like the net and the gross pay. So that, as well as the cost of the employer, which is different to the gross pay. Gross pay being top line, net pay being after deductions, and cost to employer is the cost of employing the person. It's the gross pay plus some. So that's what we're going to be covering. Let's have a look at our task and see how we get along. So in part A, matching definitions to terms, we have options of taxable pay, net pay, pay rate and gross pay. And the definitions start with the amount an employee receives in their bank for a pay period after all deductions have been made. So one of the keys here, receives in their bank. This is what the employee actually receives. We call that, of course, the net pay. The total earnings of an employee for a pay period. Total earnings could be a period, has been a month if they get paid monthly. So what are their total earnings before deductions is what it's asking for. So that is therefore their gross pay. Take that same total earnings figure for the person, but now after their tax-free portion, everybody gets a tax-free bit each year or each month. So an amount they are allowed to receive without paying tax. So we split their total into the taxable bit and the tax-free bit. This is saying after you've deducted the tax-free bit, what's left? And the answer is, if it's not tax-free, it's taxable. So taxable pay in there. Then the amount they earn for different types of work would be their pay rate. So they may get paid a certain amount for normal hours, different amount for Sundays, or it could be based on the type of work that they're doing. If they're working in one department, they might get a certain pay, and doing a different job, they get a different pay. We've then got some payroll principles. So establish whether these payroll principles are true or false. Tax codes are used to determine the amount of tax-free earnings and are unique for each employee. That's true. So HMRC will look at your circumstances and they will say, based on you and your circumstances, how much did we ought to be giving you as a tax-free amount? So whilst lots of people might have the same tax code, it's not like we have an infinite number of tax codes and everybody has something entirely different. Lots of people will have the same one, but the point is you and your colleague might not. So it's not one size fits all. There are different tax codes and some are calculated especially for you. Employer pension contributions are deducted from the gross pay. That would be a little bit unfair, wouldn't it? It does say employer, so this is like a perk of the job. So you get your gross pay, but in addition to that, they agree to put something into your pension. Very kind of them. It means it's not a cost to you, it's a cost to the employer. So they pay you and they pop something into your pension. So the total cost of payroll to the employer, this is cost to company, if you like, is the gross pay. So that's the amount that they're paying you on the top line. You don't get it all because they have to keep back a bit of tax and national insurance and maybe pension to give to HMRC and then to give to the pension company. So it's a gross pay. Then there is employers' national insurance to be added on top. So that is actually wrong. Employees' national insurance is deducted from the staff member. It should be employers' national insurance that gets added on top of the gross, and then the employer's pension. So you have to be careful here that your brain doesn't read what it wants to read, that you don't read it too quickly. There's only one letter difference between an employee and an employer, and it is a difference between a mark or not in the exam. So we want gross pay, employer pension, employer national insurance. That then becomes true. But at the moment, it's false because it talks about employee. And then a pay slip should be supplied to each employee on or before payday. Yes, so they can see how much they have earned and what their deductions are. So that's one of their statutory rights. We've now got Sammy Jo, who's an employee of Grippet. She's queried the amount on her P60 as it does not agree with the amounts received during the year. So this is what she's received. Presumably that is what has gone onto her bank account. So what do we know? No previous employment, so everything was received in this employment. So that would be her gross pay there. This is the tax that would be deducted. So of course she wouldn't receive that. That would be taken from her before she actually gets her net pay. There's also national insurance. We've got earnings at the lower limit, earnings at the upper limit. These are just there to help us calculate the national insurance due. So the amount of national insurance paid by the employee would be this one. So that would be a deduction too. We've got employee national insurance down there. We've got pay as you earn there. And then, of course, the gross pay over there on the left there. What else do we know? Sammy Jo's annual salary at the start of the year was $34,000, and then halfway through, it went up by 2. So complete the table to reconcile the amount Sammy Jo received to the amount on her P60. Right, let's see what's happening here then. So the gross pay is £34,000 for the first half of the year. So I've got 34,000 for 6 months. And then Sammy Jo gets a pay rise of 2,000. We've got 36,000 for another 6 months. So that would make 35,000 for the year. It's then telling me I need to choose something from the pick list to help me reconcile that top line gross pay with the taxable pay on the P60. Because the P60 shows me the gross, but it shows me the gross taxable pay. Because it's all about pay and income tax. So this is the gross taxable pay. So what gets me from the gross pay to the gross taxable pay, which is 33,560. So I could fill that in. So I start with 35,000, 33,560. So there's 1,440 that has been deducted here, but for what? What will be deducted at that stage? Is there anything in the pick list or anything in the question that would help me? It tells me Sammy Joe was a member of the company pension scheme. Employee pension contributions were 120 per month. Now, if you put money into your pension contribution, that is then not taxed. So you get tax relief on pension contributions. So the employee pension contributions $120 per month for 12 months, hopefully give me 1,440, which they do. So from the gross to the taxable gross, you deduct employee pension. And then to get from taxable gross down to net pay, and we know what the net pay is because the question told us right at the beginning, 26,350.41. What happens between the bit that's taxed and the net pay? And the answer is it's taxed. So we've got income tax to be deducted. And then we've got employee national insurance. The employee national insurance we found in the P60. And the income tax, I believe we also saw a little bit higher up. I take that taxable gross pay. And I deduct it. Deduct the income tax, deduct the national insurance, I get the net pay. So I check that little calculation and that does indeed add up. Gross less income tax less employers and I equals net pay. So I can be confident with my answer and I appear to have reconciled that correctly. So that's demonstrating that I understand pensions. I understand how to deal with tax and NI. I understand the difference between the employee putting money into their pension and the employer putting money into their pension, and so on. And that brings us to the end of our penultimate task. So the next one is going to be our final task, task number 8.